Alright, so I am making a video in response to, um, let's see, I'm curious if people think energy is the last to roll over. Somehow it will make it out of this bear market alive. Um, I mean, it is the strongest one. So if we go to stockcharts.com, this is something that I think a lot of people do. We can go to sectors, and then we sort RSI by the strength. And I mean, most people are they do trend following strategies. And the problem with that is that they don't know when something's overbought and ready to reverse. And there are signals that are saying that it's beginning to reverse. Seasonality for one, two, the I guess XLY, discretionary versus consumer staples. And then on top of that, maybe the forward yield and the euro dollar futures curve, and just what that's saying about rate hikes. So here we get the idea that the energy is in the strength, but it also is at a place where it can reverse. And because most people like to stop at the trend trading and they don't like to take on more context, that's kind of where they would get that idea, and they would get trapped by institutions. And we could tell right here, you could go through, we'll go put this on the SPX really quick. You could go to, I forgot, Smart Money Insights or something, or, a place where you could see, I guess, commitment traders agreement, like the institutional bias. And here we could see that institutions are short on the S&P 500, and almost on commodities as well. That was all on DBC. For the short term, it's leaning a little bearish, not 100%, but if they're leaning bearish on the index, then it's kind of saying a lot. Now, I will say it's a little bit before the CPI reading. I would give it like another week, but all in all, it looks like it's coming to a close soon, and further evidence of that is, okay. Let's look at the seasonality. Let's bring this. Stop. All right. So seasonality wise, we could see that. So this is true seasonal, and we could see on commodities that it just craters in December 13th, 2022. That's what the seasonality. If you don't like that seasonality, Stock Charts has got a seasonality. So November is pretty low, it looks like. Here it's got seasonality strong. I guess maybe that's. I have no idea what that kind of event is, but if we were to look at, maybe let's try company. I don't know if that really did anything, but there is some fundamentals about. I've heard stories where they have more than enough supply, and that they're having kind of a delay of winter in Europe. So now they got a glut of energy and natural gas, and with China and their COVID, still locked down, they're not going to be ramping up at any time soon. And then oil is in contango. There's high demand, but right now I think the usage of gasoline is lower than it was in COVID because of demand destruction. and you could see demand destruction from XLY divide by XLP right here. We'll put this into the quarterly, and you can see clearly, where deviation, left shoulder, right shoulder, resistance around here, and we've totally been rejected by that area. I'm gonna get rid of these lines because it seems like it's far away from it to where we would need it. So like the next point of possible reversal. So basically, what this is saying is that demand of discretionary of consumer goods is squashed, and people are fleeing to safety, consumer staples. So I mean, you could see that base metals versus precious metals, lumber versus gold, and this is more of like a near term kind of thing. But if you also wanted to look into the Fed data, you could. We could look into like a consumer cyclical or consumer durables, and I could show you that kind of fundamental data. But for the most part, like pretty persuaded about the seasonality of this, and then the weekly market structure break to the downside. The solid block means it's a breaker. The hollow is an order block. This is the weekly, and we have a retest into it. And currently, this, I guess, last week high is resistance. I would expect it to maybe peak above and then reclaim to the downside. And it's got a weekly bearish order block and a weekly breaker. It's still there, and it's on both Brent. This is Brent, sour crude, sweet crude, West Texas oil. It's on both of them. So the whole seasonality narrative, the whole narrative about consumer spending towards energy is pretty low. Around, it's kind of at a low, similar to COVID. As far as the demand, I don't have that data on hand, but I heard it from Jeffrey Snyder. So that brings to question, like, when are we rolling over? Because like it looks like it's pretty evident, and starting with ES. So this is the H4, and right now we're kind of above a H4 breaker to the upside, bullish. Now the H4 and the H12 are in alignment. They're in agreement of bullishness. So it's going to go get liquidity. So this is kind of like the quick answer is that I think it's going to purge this liquidity zone up into the maybe 150 SMA, and then that be it, and then reclaim this last week high. I'm basically gonna just set an alert here. Last week high, we want to, I guess, less than, crossing down, yeah, per bar. So we're gonna purge this liquidity, and if we go to West Texas oil, it's a little bit of the same story. So this is the H4, this is the bullish breaker with the retest right here, and H12 bullish breaker to the upside. It's bullish with a retest into this 24 moving average, and the idea is that there's no real liquidity, except up here. So we expect it to go up here in some way, up to the 150, and let me see. And on the moving average channel here on the weekly with a 20 setting, I think that's basically, if we were to put it lined it up really quick. yeah, that's I guess if we hit the 150 or this 20 moving average here, that would put us right at the purge of this order block of the liquidity, and that would hit the ceiling of this rising wedge. Um, it's I mean the pattern is there for a rising wedge. We're at support. We broke up swing failure pattern deviation, left shoulder, right shoulder. We're holding this level. We're getting ready to shoot up. So it to me it makes sense if we look at this is the most recent pull of Monday's price with the cycle. This is the fast cycle, and I think this is kind of um, out of phase a little bit. But I think these hard cycles, the annual, the decennial, the 4 year, and the annual, they're all basically saying the same thing. That we're expecting some kind of event of a reversal coming into 11:10, 11:9, 11:10. That pretty much snipes the beginning of the downslope of the bell curve, and that happens to be, lo and behold, I gotta open up my history because Forex Factory calendar next week. Ta-da! Right here, CPI on the 10th, and there's a bank holiday on Friday. But so let me kind of review what I've said. I've said basically the cycle forecast is saying, hey, there's more upside, and we are expecting a reversal to the downside November 9th and 10th, around that time frame of the CPI. And then also there's liquidity on the upside. So if we were to make our own narrative, we would say price and the market structure are both, like the H4, H12, they're all in alignment for bullish. They've retested the breaker to the upside, except ES. The S&P 500 hasn't retested their breaker, but both the oil's weekly breakers to the downside. So that's the big sentiment right there. The main thing that's going to be controlling everything. It's just when they all go in alignment to the downside. But right now, H4, H12 are in alignment to the upside with a retest into the breaker, and we're expecting it to go up and get that liquidity on the H4. And what is the Fed going to say when the market goes up and gets the liquidity on ES and oil, where it's all the way up here? They're going to say, hey, inflation is still here. We need to attack this thing. And lo and behold, they're going to hike rates. Obviously the people are trying to make sense of the whole narrative that people are putting out there, that it's priced in. And that is a load of baloney. How in the world do you know if it's priced in or not? Like, who is the authority and has the technical to be able to say, we're priced in, we're not priced in? Come on. Like, you gotta be, conning me if you're telling me this narrative baloney of priced in, not priced in. It's just market structure and events. That's it. And probability. Certain market structure gives a higher probability for a certain event. And if it's overbought, oversold, that's kind of just, I'm talking about like RSI. That's kind of what I'm going off of, not off of priced in. And I don't know. It's just, I don't know how people are able to invest with this whole priced in narrative thing, but it's not good for deploying money. That's how I see it. But yeah, I mean, here we can see, even here, the weekly market structure break to the downside. It's pretty bad, but we could expect price to go up into here It looks like around a 97 on oil, and if we look at the ES, it looks like around 4,000 on ES. And then that's pretty much where the H4 is going to grab liquidity. If we go to the order blocks, the blue things are the order blocks. 4,000. You would have purged all these bearish order blocks liquidity, stored up energy to now go to the downside, reclaim this last week high. Boom, it's toast. That's the high is in. That's kind of just the idea, and that's most likely probable because we're using math models. These are statistical events using time, and obviously there's a divergence between the AI fast cycle that selects cycles for intra-week analysis, and then the hard cycles. But I still believe, with this hard cycle and the coincident evidence of the CPI reading on November 9th and 10th, and then not only that, we look at our treasury bonds like 3-month, 10-year inverted, 5-year, 30-year inverted, 2-year, 10-year inverted. We look at percent inversion of yield curve. We're around almost 50%. We're at 47.27% inverted. And then, if we were to go to the rate hikes and figuring out potential levels, we got 4.7 pricing in from the Eurodollar futures curve. If we check out the forward yield, which is the 30-day contract minus 100, we got 4.9. So we're expecting the what's it called, Fed funds to be going to 4.9, 4.7, 4.9. Eurodollar futures 4.7. The 30-day Fed futures forward yield 4.9. So we're expecting more rate hikes. This is a scam pump. That's basically what we could say. And we got another, I gave you a date. You could also do it by market structure break. So by next week, look for an H4 market structure break to the downside. And you should be set. That's pretty much the simplest I could boil it down to. And a way you could determine market structure, Nephew Sam, he's got some great tools. I like his break of structure, change of character. There's another one where it's just market structure. I use that on here too. I use both of them. It says bullish, but that's here, market structure, Nephew Sam, and you can pop up the time frames. But that's kind of just what I got. I do want to talk about more of the fundamentals of just the mortgaged backed applications, the mortgage applications, the builder permits, the new single family houses data, cyclical, durable goods data, manufacturing data. I want to go into all of that. It's just, I'm about to go into work, and just kind of want to relax before I go into work. But that's something I want to get into. I do want to compare also EBP Research. I think his name is Eric, with the last name I can't remember, and then Jeff Snyder. And I just want to compare how they've kind of arrived almost at the same conclusion of just the data, but from different parts. Jeff Snyder, he's rooted in the Eurodollar and the Eurodollar narrative. And then Eric from EBP Research, he's rooted in the demographics, and then other leading indicators like policy, rate hikes, and mortgage applications, all those other fundamental stuff, building permits, all that kind of data. and I can get it in. The weird thing was like I was like, well, I can't really put a whole like moving averages on this stuff. Maybe I can. We'll see what we can do with TradingView. I know it's kind of limited on what it can do, and then we also can pull Fed data here on the timing solutions. We have access to the, and that's my API key. If you wanted to get access to Fed data, there you go. But we're gonna play with the because we can do like fibs, we can do like lines, and we could do some sort of like market structure kind of things, pitchforks for trend. Um, so, some ways where we could quantify a change of character or a break of structure, and I think that's kind of what we're after with the hard data, because like there you go again, like this kind of question: how do you know when there is a break of structure or a change of character when looking at this stuff? Is it by a percentage drop? Like the whole same thing with, how do you know it's priced in? Like, like I don't know. It kind of is like some kind of quandary for me how to understand all that. But hopefully, I laid out my case. Most of it was from a technical point of view with smart money concepts, with order blocks and liquidity and where that's at. From an order flow standpoint, like a market profile standpoint, I don't know. I like this view better than a market profile, and I am looking at a volume foot map here. I can't get it over H4, but so far I'm not seeing a whole lot of I don't know, a whole lot of data to where I can see that far in the future. It's more of like a immediate of what's happening. Is there like a shift in the this H4 H12 divergence of a structure, and that's kind of why I got that. But the best that I can do is pairing math cycles, institutional bias with smart money concepts, and the math cycles, doing a lot of heavy lifting with determining bias in alignment with institutions on key dates. So that's basically my case put forward, hopefully in a very orderly manner. I'm not 100% sure on that, but it could be better. But I think I laid it to where it was understandable. Thanks for watching.